This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all.
Right, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. On the weekend, we like to come back and re-examine the base case hypothesis of the channel and check to see if, largely speaking, things are still going according to plan. And then at the end, assuming they are, I can have continued confidence in my positioning and in my posturing, and I'll show you the TA and the live trades and all of that kind of thing, as always. Now, I appreciate part of what we do here is trying to be as consistent as possible, but I hope you can appreciate sometimes I get sick of my own voice and sick of repeating these things week in, week out, and I actually know that's very important for maintaining consistency, not moving the goalposts, right? Having a framework and operating within that framework until such time as it either is proven correct or is invalidated. But in the interest of trying to keep things a little bit novel, a little bit new, a little bit fun, and perhaps even mildly refreshing, I wanted to show you kind of the same, but different, okay, this time, and in an attempt to just not get so sick of saying the same thing week in, week out. And then as of next week, I think we'll go back to the standard template. So hopefully this one's a little bit nicer on the eyes, not quite as copy and paste as you are used to. I have got new inflation data to show you. I've got an updated idea for Bitcoin, and then I'm in the process of writing my first article. I'm just playing around with it on X, but I'll show you that because I created a whole heap of new labor market charts that kind of support my idea. Without further ado, do consider subscribing, turn the notifications on so you can follow along with this hypothesis of mine. And other than that, let's dig into today's episode. So at the lows for the stocks, the base case was that we were too bearish. We'd have this big blow off top to all-time highs, come tumbling down in a global bear market and recession, and that this recession would see a short period of asset price deflation. It's also been the idea that when we eventually get our blow off top here, it is going to take a long time to actually recover the highs. So it's probably going to look something like this, and then a whole lost decade in here of stagflation, whilst the oscillator down the bottom resets itself. Very similar setup to the prior lost decades that we've seen throughout history. Fast forward to today, and I make the case that this is the final leg to the upside, and when this eventually comes tumbling down, and when this trend line eventually breaks, we are going to be in a true bear market. I think we're already in a global recession. Again, I'll back this up with data as I continue to progress through this presentation. And I believe that we have to go and head for some 4-year cycle lows not due until late 2026. So as you'll see at the end when we get to the live trades and positions, I am still postured long. I suspect I'll continue to be postured long across the board for a while longer. It's just at some point in the not too distant future, it's going to be time to lock in some gains and head for those 4-year cycle lows. And as a cycle trader, you know, that's my bread and butter. That's what we do here. So wholly speaking, okay, I think we are getting dangerously close now to seeing a top. Now, there's always someone that comments something like, does that mean I got to sell everything? Look, you do you, okay? Don't even assume I'm right, okay? Make your own decision, take it or leave it. It's entirely up to you, okay? But that's not what this is supposed to be. It's not supposed to be a everybody panic, recession is here, all of that kind of thing, okay? If the charts are going to keep going up, then I'm going to stay long, okay? I'm not trying to jump in front of any trains here or think that I know something the market doesn't. I'm just simply saying, okay, the reason I use trend lines on the chart is I need an area on the chart to manage my risk around. And this, for me, is it. I think if this continues to go up like this, it's unsustainable, it's too vertical, and it will have to come tumbling down. Worst case scenario, I see something like this, we exit in profit, okay, we wait for momentum to return, and then as it proves itself to us that it's not actually topped and we haven't got a recession and there is no bear market, then I can talk about re-entering on momentum returning and the market proving me wrong in my idea. Nothing wrong with that. And of course, in the best case scenario, then I'm absolutely correct in my expectations. We sell the top and we enter a big global bear market and recession whilst sidestepping the drawdown, which is my primary goal here. So again, we don't have to marry any idea. We don't have to get emotional about these things. We just have to say, is the chart going up? For now it is, so we stay long. And when that trend changes, then again, it'll be time to duck out of here and play a more defensive posturing. I do also want to point at one thing here, okay? I think this pullback shakeout for the tariff tantrum here before this final push to the upside is extremely reminiscent of this chart right here, okay, where we get the bear trap followed by the big blow off top to all-time highs. I think this is what we've done, right? And we're already kind of here now, aren't we? Okay, so if, again, I'm right, this trend line that I showed you in red here will continue to hold for a while longer. We'll get a kind of grand finale into the final blow off top high, and then this thing should come tumbling down. For Bitcoin, the idea was pretty similar, okay? We've been tracking these weekly cycle lows that occur approximately every 6 months. They've been extremely consistent, as denoted by these timing arcs down the bottom, which are equidistant. Out of every prior weekly cycle low, we have yielded approximately a double from the low to the high for the weekly cycle before then resetting into another weekly cycle low. And so the idea was pretty simple, that we would just do the same thing again. Weekly cycle low, double off the lows. That would put us around 150k. And then if we were lucky, we might do the whole thing one final time to give us the top for the 4-year cycle before we enter that bear market decline into the 4-year cycle low late 2026. Now, this idea kind of worked and kind of didn't, right? We did get a weekly cycle low. We did get a push higher out of that weekly cycle low to new highs, but we did fall significantly short of the 150k-ish region that I was looking for. And we gave this thing a lot of space, and I kept saying, you know, one day at a time, let's see. It's not broken any structure yet. It's not made any new lower lows. It's not breaking anything down. There's no failed cycles in here. So, you know, the trend is still up, even though, admittedly, it was a less powerful push for this weekly cycle than I was anticipating. But now we've given it enough time to actually kind of get to this next weekly cycle low window. I started to look at this and think, well, if we're being honest, doesn't it kind of look exactly as expected, just with one small difference, and that's that it didn't quite cover as much ground as we thought it would? What I decided to do was kind of just squeeze this box at the top here down to encompass the high here, and I'll do some adjustments for you, and we end up with this. It's practically the same thing, it's just it didn't make the target. But in terms of time, we did get a weekly cycle low, we did get a push of nearly 70% off the lows, so not that far below the 100%, and now it seems like we're in the process of correcting into another weekly cycle low. Could it go lower? Yeah, for sure. Could it be in already? Also possible. But really, I think all that matters is, so long as we don't break any structure, so long as we don't fail any weekly cycle lows, and so long as we can actually get a push off here in the coming weeks to new all-time highs, then I don't think this thing is super out of the ordinary. Now, I know some people will say, yeah, well, this failed, it should be 150k. I know, right? But this is a market. You have to have some degree of leeway, right? Like, it's nice when things go perfectly as per expectations. It would have been lovely to point at this having hit 150k and say, there it is, guys, like exactly as expected, okay? But sometimes the market doesn't behave exactly as expected, and this is one of those times. Again, if I put back on the original chart here, it seems like we've got the relative shape here and the amount of time correct. It's just we didn't quite cover as much ground as I was hoping for. And again, if I just leave all of the stuff to the left-hand side of this weekly cycle low untouched and just change this hard right edge where I just pull everything down slightly, then what we get is this right here. And I would say to you that that's not that bad, right? Now, if you want to reject it, that's fine. I'm not trying to sell anything. I'm not trying to push this idea on anyone. For me, though, this is good enough for me to start to look for one final weekly cycle low. It's also enough for me to start to look for trade setups out of this weekly cycle low and perhaps one final push to new all-time highs. Now, again, how high does it go? As anybody's guess, okay? I would think we could conservatively get above 150k in the next weekly cycle because, you know, from where we are now to about 150k is really only about 30-ish%. It might even be slightly less than that. So I think we can easily do that inside of a weekly cycle. We may need to wiggle out a few more lower lows first, okay? That's entirely possible just on the short time frame over the next 2 to 3 weeks, or we could be bottomed here and ready to rip higher. In either case, it's not really my job to kind of try to guess what's going to happen. Instead, I would much rather let the market show me and just react to that, right? Hop on a breakout to the upside if need be once we've confirmed a cycle low. And if not, then we'll just be open to another low to form inside of the next couple of weeks. But at least for me as a cycle trader, this is pretty much okay, right? I don't see too much wrong with this. It's always the lows that we're focused on, not the highs. And if we can get another push from here, that's good enough for me. So I'll leave that up to you. If you want to reject this as an idea, then I'm totally okay with that. I should also make a couple of important points here from a cycle perspective. Okay, right now, bull market invalidation for me is the prior weekly cycle low down at about 74k. I don't think we've got any business trading below that and continuing to suggest we are still in a bull market. Once this weekly cycle low that is upcoming, could be in now already, as I said, or could be in the next couple of weeks. Once that low is in and confirmed and we're at new highs, I'm going to move my bull market invalidation to wherever that low is, okay? And I also see some people when I say this talking about how, well, why not just sell now for 115k instead of risk it coming back here, okay? And the reason is I'm looking for higher numbers and new all-time highs. I'm looking for something like this yellow squiggle to occur so that I can sell a trend line break much higher up if the market will give it to me. This is kind of like the stop loss, okay? This is like the manual stop loss. This is where I say we have no business trading below that weekly cycle and failing the weekly cycle this late in a bull market. If we do, then we have to admit something is wrong here. We're going immediately risk off, immediately into a bear market, and we have to dump the stack in defense to protect against giving back and round tripping the entire set of gains from the 4-year cycle lows. And all of that applies once we shove this invalidation up higher. But the reason we're not just exiting now is because potentially there's a push here to 150, 200k. Like, nobody knows, right? A lot of people say that's impossible, but it really isn't impossible. Frankly, betting on a move like this for the stock market was far less likely than Bitcoin doing a 100% move from where it is now. So I'm personally not going to discount it. Again, you can feel free to discount it if you want to, but I say I'm going to remain a bit optimistic here, looking for a low to confirm, looking for a push to new highs. As I said, then my hard invalidation, my kind of stop loss for the spot bags becomes wherever that weekly cycle low is, which guarantees me something in the neighborhood of 500 or 600% for this bull run in the absolute worst case scenario, and hopefully we can get closer to a 10x and above. And if we can indeed get that push, then again we'll go to sell and trend line breakdowns as always. But again, just to summarize Bitcoin, it looks pretty much like it's supposed to look. It's just we didn't quite cover as much ground as I would have hoped for, right? But we squeeze those couple of boxes down, we get this. It's good enough for me, and if it's not good enough for you, again, I understand that. I'm not suggesting you need to listen to anything I say or follow anything I say, just simply consider it and do with it what you will. So moving on, got some new inflation data to share with you. As I said at the start, if we are going to have this bear market, I've been calling for there to be a short period of asset price deflation. Not something we see very often, but the primary reason for this is anything you do here to the M2 rate of change shows up in the CPI with a lag. Since we slipped negative here, I've been suggesting that, we're going to do the same thing down here, okay? This is just how it tends to work. Here's an update, okay? We are most of the way down, okay, and continuing to be, wholly speaking, disinflationary. Yes, there are short-term wobbles. Yes, people like to look here zoomed in and say, well, that's sticky inflation or inflation has bottomed, but I maintain it's very silly to call for something like that when this is the overall trend, okay? So until such time as this thing starts to really ramp up and break out, okay, set new higher highs and higher lows back to back, then it's really silly, in my opinion, to be calling for the resumption of inflation or even a bottom of inflation, especially given the interest rates are overly restrictive at the moment. And this was the internet's favorite inflation fractal for a while, wasn't it? The current day is nothing like the 70s at all, and that's how we knew that we weren't going to get something like this again, despite the masses calling for it. And our idea here, while somewhat controversial, I think it's certainly less controversial than it once was, continues to be validated in real time, right? We've got the PPI coming in deflationary month over month this week, and heavily disinflationary year over year. Of course, this follows on from PCE data that was revised down for Q2, okay, from 3.8 in Q1 to just 2%, which is at target. Remember, it's not 2% CPI that the Fed is targeting, it's 2% PCE, which is roughly equivalent to about 2.5% CPI, and core revised down from 3.5% in Q1 to just 2.5%, okay? So we continue to make the case that inflation is tamed. Some of you will, of course, be sat there going, well, what about CPI, right? That came in, quote, sticky or warm or hot, whatever you want to call it. But once again, for who knows how many times, it's driven by shelter, not the actual inflation data, okay? So if you take the government print at face value, sure, okay, inflation looks, as it often does, sticky and warm. But if you know where to look and you're willing to do a little bit more work and dig underneath the hood, we're actually nowhere near the reported number in the real world. So headline CPI at face value came in at plus 0.38% month over month, which is the hottest since January, whilst headline came in at 2.92%, which is 0.4 percentage points above the Fed's implied target. Which of course begs the question, what is it exactly that drove the increase in August? And you guessed it, once again, it's shelter, the biggest lagging component in the CPI basket. But if we use something like ALNRI, it was actually deflationary month over month again in August, right? So when you use something like the ALNRI here in red, which is a much more real-time and responsive metric, as opposed to CPI shelter, which is a huge laggard in the basket, what you actually find is we have been deflationary for a long, long time pertaining to the shelter component. It's just the metrics that the Fed currently use don't show that. Now, again, I maintain this is deliberate. I don't think this is incompetence or we're somehow smarter than the Fed. I just simply think they don't want to let on that they've already tamed inflation because they are using the idea that inflation is sticky to justify these higher interest rates. But again, the important thing to note here is, whilst the shelter component is up 3.6% year over year, the real-time metric, okay, is deflationary by 0.8%, making a huge 4.5 percentage point gap. And thus, this increase or this seeming tick up that we saw in CPI is actually not worrisome because it came from shelter and not the other components like most expected after these allegedly inflationary tariffs. So shelter is actually lagging 3 years behind actual rent inflation. The Fed is hoping for that component to come down soon, but its drivers are a bit different than how it's often presented. And whilst core came in slightly hotter and perceived as sticky based on the headline value, again, it's artificially higher due to the shelter component. And if we replace shelter with ALNRI, both core CPI and headline drop to a zero handle. Take a look at this at the hard right edge, okay, below 1%. So what does all this mean for the Fed? Well, it means we know a 25 basis point cut is coming, but again, we've known this for a while because of the whole tell that to the bond market thing, right? We point at this and we say tell that to the bond market because it's the bond market in aggregate that determines rates. Right now, we are above 85% in one direction, in this case, for a 25 basis point cut. So we know that 25 basis points is coming, and it's a pretty easy justification for the Fed to say that. It should also be pretty easy for them to point out into the future and say more cuts are coming thereafter. And whether they actually deliver those cuts and at what pace will depend on more months of CPI and labour market data, and I'm sure they're going to continue to do what they've been doing for a long time now, which is fudge the CPI data and quietly revise down the labour market data after the fact until such time as they are ready to let this thing come tumbling down, which I'm sure we will see manifest as a whopping trendline violation in the stock market. But wholly speaking, again, it's the same theme, isn't it? If you know where to look, if you're willing to, rather than take the data at face value, just do a little bit of digging around under the hood, what you can actually often find is that, once again, we are being lied to. Whether it's the labour market, the GDP numbers, or the inflation data, we consistently are being lied to. We have been spoon-fed an idea that everything is fine and dandy, when in fact it is simply silly to say that. Of course, if I'm calling for a recession and a global bear market, then we'd expect to see labour market deterioration. Now, for a long time, people were challenging this idea until they started to massively revise the data down, right? And now I think it's pretty much consensus that the labour market is in a little bit more trouble than many people thought. But I've been playing around with this article thing, as I said earlier, on X. I'm going to release this later. It's not anywhere close to being finished in terms of annotation and comment, but the charts are pretty nice. So I thought I would share some of these charts with you instead of just kind of look at the same old data that we do every week for the labour market, okay? But remember, the base case hypothesis is that we are going to see labour market deterioration. So notice here, at the top, we've got the S&P 500, and at the bottom, we have got the unemployment rate, okay? What do you see? It spikes into recessions as the top comes in for the stock market, okay? And right now, we have got a lead in before a potential spike to the upside. Right here at the top, we've got the same S&P 500 chart with the prior recessions marked out, and underneath, we've got the United States Consumer Confidence Index, okay? Notice how this is rolling over during the recession as the stock market has topped. Same deal here, okay? Same deal during C19, and at the hard right edge, it continues to decline, showing no signs of improvement whatsoever here. And again, I continue to make the case that when the NBER goes back and paints the recessionary bar, which remember they always do about 12 months after the fact, okay? In the GFC, I always point to this one just because I have the dates committed to memory, but they didn't declare this recession was official until December 2008. But when they did so, they went back and painted the bar starting from December 2007, right? A full 12 months after the fact. The stock market had already fallen about 45%. And was almost at the lows by the time they officially declared the recession. So waiting for them to tell us we're in a recession is not going to be a good indication for being able to sell the top, right? And again, here, it's going to be pretty obvious if they go back and paint the recessionary bar somewhere in this kind of neighborhood, right? It will just look like every other prior recession. It's also a very similar idea here, right? S&P again at the top with the recessions marked. And this is United States non-farm payroll jobs created. Again, declining into a recession, declining into a recession, declining massively here. This thing has been in a downtrend non-stop since about 2021. Okay, so again, at the hard right edge, doesn't really look like we've got any signs of a recovery or a reversal, or like we're going to be able to swerve the recession. Next up, I got a bunch of manufacturing charts. They show an incredibly similar look. Again, at the top, S&P 500 with the recessions marked. Down the bottom, we got job openings for manufacturing. Notice how they're declining throughout the recession, same deal. And at the hard right edge, you guessed it, showing no signs of reversal or bottom. So to say that everything's fine, those liquiditists that are out there at the moment calling for things like we're early stages or re-acceleration is coming, I mean, it's just silly to me. I don't see any evidence of this whatsoever. Fitting in with this theme of manufacturing, okay, we got more of the same. This is United States ISM manufacturing new orders. Again, declining into a recession, declines into the GFC, declines into C19. And here we are barely above 50 since all the way back in 2022, right? Remember, breakdowns below 50 signal recessionary periods, 50 being the green horizontal bar here. So does this look like any of the recovery phases, the uptrends that we saw out of the prior recessions? Not at all, right? We are still chopping around here. We're still susceptible to rollover. And we can say the same thing when we look at manufacturing payrolls here, okay, which again decline into all of the recessions and are turning down at the hard right edge below the signal line of zero this time, okay? So again, until such time as these things turn up, it's still kind of silly, in my opinion, to be saying things like we're at no risk of recession here, right? This couldn't easily and rapidly deteriorate. Other things I've been showing are things like the Buffett indicator being at 217%. We are record overvalued in the stock market. You can see here, Buffett indicator during the dot-com bubble. This is it back in the GFC. And here we are, the hard right edge, massively overvalued. And I understand that metric is heavily contested. A lot of people want to disregard that. That's fine. Okay, if you want to disregard it, I'm not trying to convince anyone of anything. I'm just presenting data as I interpret it. But whether or not you agree with the Buffett indicator or think that that's outdated, the value of public and private equity to GDP ratio is also way higher than it was in the prior instances of recession and is forming a lower high and a rollover look at the hard right edge relative to the peak during the C19 recession. Okay, so we're still very vulnerable, we're still very overpriced, and the mean is all the way down here. Okay, so a whopping great mean reversion is likely on the table. Again, at the top we got the S&P, and at the bottom this time we got the yield curve, right? The yield curve is inverts, reverts, and accelerates, and it's always the acceleration that marks the tops, right? Everyone screams recession when it inverts, they scream recession when it reverts, but it's actually only with acceleration to the upside and cuts into a slowdown that we see the top come in for the stock market. Now, at the hard right edge, is very nearly borderline on accelerative sweep territory, right? It's not quite there, but it's also of note that this is not only a record inversion in terms of depth, but also in terms of time. This is record inverted for a record amount of time. Again, and under the hood, as I've just shown you, all the labor market data is really bad. The manufacturing data is terrible. They consistently revise this data down, so it's probably even worse than they're letting on. They're also massively behind the curve of inflation, and these are most probably going to be cuts into a slowdown with an accelerative sweep in the yield spreads. And again, the NBER is likely going to go back and paint the recessionary bar, right? And then we'll be able to look back at this stock market breaking down from this near vertical blow off top angle and say, well, yeah, like what else did you think was going to happen, right? Like it just makes a lot of sense to me. Again, as ever, I'm open to being proven wrong by the market, but so far I don't need to shift around any of my ideas. I don't need to abandon any of these theses. None of them have even come within a whiff of invalidation yet. So far, things are playing out according to plan, and thus, I'm not going to throw my idea out the window just because it makes some people feel uncomfortable, right? I'm going to stand here and it's either going to be proven right or it's going to be invalidated. Now, I don't mind which one it is because it's not about saying I told you so or getting this right. It's simply about having a framework within which I can posture and position to have confidence that I'm on the right side of the trade, right? That's why I do this. It's not an I told you so game. It's simply, I don't want to be long the stock market if the thing is in a downtrend and a bear market and a recession is here. But similarly, I'm more than happy to be long postured in the stock market until such time as things actually break. But also to say things like, well, it's a buy and hold environment, okay, we're going up only, we're early in a cycle, all of this kind of thing. I personally, respectfully and humbly think that is ludicrous. I think that's absolutely ludicrous. I think this is a bull market that spanned over 4 decades and is getting ready to have a spectacular finale and blow off top before coming crashing down in a whopping great bear market and deflationary recession. And again, when we go back to this article I'm producing, right, I mean, is it really surprising? We're in phase 4 of a hyperwave. Like, how do you think this ends, right? I mean, all of this to me just looks like we are continuing to be on the right side of the trade. The last few things I wanted to show you today before we hop into some charts are, this is the S&P 500. A lot of people are familiar with Bitcoin's 4-year cycle, but the S&P also has one, okay? And we are due a 4-year cycle. Look how much time we've used up, okay? It's not that far away now. And also, it happens to be synced up with Bitcoin's 4-year cycle low. Again, we have used up a lot more time and are due to start declining as of probably the end of this year into that 4-year cycle low for Bitcoin. And at the same time, gold, which has an 8-year cycle, has its half cycle low, all synced up at the same time. So I think we're in here for a whopping great correction into next year. And I think the writing's going to have been on the wall for a while. And again, with all of these revisions going on that we've been covering week in, week out, the data is way worse than anyone wants to really discuss. We also saw Goldman Sachs downward revision of up to 950k jobs, right? And you know, here's the other one that we saw, right? US payrolls revised down by 911,000, right? The largest cut in history. Does this say to you that we're early stages and that everything is fine under the hood? I mean, if it does, that's fine. That's your prerogative. But for me, that's just not something I can accept based on everything I've been seeing. And so we know we've got some rate cuts coming this week, and that's fine, okay? About time. We know they're continuing to be overly restrictive, and we speculate that that is deliberate as part of this controlled demolition. And most importantly, we also know that context is key here, okay? If we are cutting into a soft landing, which the masses predictably, as expected, think is now the base case, then we can be bullish 3, 6, and 12 months into the future. But of course, the Camel Crew likes to take the contrarian approach and says indeed that this is a recession cut. Okay, we are cutting into a slowdown, and therefore, after the first, 1 to 2 cuts following the pause that we saw from the initial cut back in September of last year, it's likely that we're not going to get much more than 1 to 2 cuts into the future now without seeing some major tops and some major breakdowns across the board. it is pretty funny that right as we've gotten here, the masses have accepted the soft landing. They have been predicted to do so, predicted to point at earnings and rate cuts as bullish. But again, we continue to say we saw that coming years ago, and these are indeed cuts into a slowdown, not cuts into normalization and a soft landing. As we always do towards the end of these presentations, okay, we point at things like bankruptcies skyrocketing, Google searches for give car back being at all-time highs, along with auto loan delinquencies and this kind of thing being at levels at, near, or in excess of the 2008 GFC, as are credit card delinquencies, right? Meanwhile, there's 6.1 million plus Americans in default on their mortgages at the moment. And I've got even more data that kind of supports this at the moment, okay? Because Google searches for things like sell my house fast, give car back, borrow against stock, borrow against life insurance, sell my Rolex, and bankruptcy lawyer are all going parabolic at the moment. So again, under the hood, the consumer is still very, very damaged, and it is the consumer that drives the economy. Since they are damaged and Googling things like this, they are certainly not out and spending and driving the economy, and thus it is only reasonable for me to continue to expect this recession to show up by 2026. We can already see this with things like mortgage applications being down 34% from pre-pandemic levels. It's even worse than 2008, okay? So how much worse is this going to get? I have no idea. But again, it's important to be able to hold these two opposing views at the same time. The markets are not the economy, right? The economy is clearly in a bad shape. It's clearly deteriorating day by day. But the markets, they are continuing to move higher, as we've said a dozen times. We continue to stay long until we have reason not to, which at the moment we do not. There are still no alarm signals in the form of the high yield credit spreads breaking out. But when they do, okay, it will be time, especially when coupled with stock market breakdowns, to start to get immediately defensive without asking questions. And I kind of already touched on this, but the same is true of the yield curves, right? We've already started to see some deterioration here. At the hard right edge, we have bought ourselves a little bit of time since the tariff tantrum back in April, right? We are still trading sideways in a range, and thus we don't have to go sounding the alarm just yet. We don't have to go panic selling. We don't have to be a doomsayer, a naysayer, or a perma bear, or anything of the sort, right? We can, objectively speaking, acknowledge that the economy is deteriorating rapidly. It's in a worse state than it has been for a very long time, while simultaneously saying the markets are not the economy and they can continue to head higher for a while longer. So until such time as we get an accelerative pop here, there's no real reason to be super alarmed, okay? And thus we continue to be long biased and long postured, as I'll show you in just a minute. Right before I do, I want to show you a sharper version of the yield curve, okay? When the 10-year minus the 3-month yield spread starts to spike, okay, the top is normally already in. You have even less time to react, just like you did in prior instances, right? The dot-com bubble burst, the GFC, the C19 era. So far though, okay, no sign of serious deterioration in the stock market, whilst the economy is terrible, right? Whilst they keep lying to us about all the data, the stock market and the alarm signals are yet to fire any true exit the market signals, okay? And it is because of this that we continue to rock with more and more long positions, right? We've been playing pretty much all of these daily cycles, and the way we continue to be long biased, we continue to look for another daily cycle low in the not too distant future, and we continue to be long and strong until we have reason not to. For gold, again, we've got our most recent position out of this weekly cycle low, and we are expecting this thing to have a big blow off top, something in line with this yellow fractal, okay, that we've been following quite closely. It was tracking incredibly closely here. It's only this cycle consolidation took a lot longer than expected, but it seems to be back on track now. How high it goes is anybody's guess, okay? It's by no means me predicting 6,600 an ounce by October 29th, okay? But if it happened, I wouldn't be surprised either, okay? So we're long and strong until we see some breakdowns there. Continue to catch this in the level 3 member section by the miners and stuff, which are all in fourth angles now, by the way. Now, again, we have to ask ourselves openly and honestly, no matter how bullish we are on certain assets or certain asset classes, how sustainable are third and fourth angles in the likes of, you know, miners like this, right? This is GDX. The senior miners are in a fourth angle, right? They've entered the timing window now to start to look for sells. So this fourth angle will violate soon, because the more vertical they are, the more prone to failure they are, okay? And when it does, I suggest to you that that's the top for this weekly cycle and the half cycle high before that decline into the half cycle low in the 8-year cycle for gold, right? AKA the 4-year cycle. So it's very soon to be time to take some profit across the board. This is SilJ, right? The silver junior miners, again, long-term and short-term accounts here. Look how vertical it's going. We have also nearly entered the timing window for this to be looking for sells. And again, Bitcoin could be done, right? We are still rocking with a couple of accounts here. There's still a couple of ideas, but we'll give it a few more days, right? I would like to see a quick weekly cycle low flush, really. That would be the best case scenario, so we can get that weekly cycle behind us and and then look out for a big strong push into the end of the year. Otherwise, this yellow squiggle is still on the table. And again, we'll just keep taking it one day at a time. One thing I do like that supports the idea Bitcoin is probably bottomed here is some of these mining stocks like Riot, for example, they just continue to blast off. The same is true of things like Wolf, okay, continues to blast off. Even things like Bitfarms, which was a laggard, okay, is now again blasting off, and we're absolutely smoking these in the level 3 members section as well. So, I mean, it looks to me like, as bearish as I am on the economy, right, as bearish as I am walking out 3, 4, 5, 6 months into the future, for the next couple of months, I'm also extremely bullish, right? I'm bullish for a few more months, and then it's time to, for me at least, unload everything, go to almost 100% cash, go and enjoy Christmas, and I expect to start next year with some nasty corrections, some nasty bear market, and I also expect to be quite a lonely bear during that time. I think a lot of people are going to be cheering on extended cycles, no more 4-year cycles, right, early in a bull market, all of this kind of stuff. And if I am correct and the sentiment is pretty bullish going into next year after I've offloaded my positions and after I become a lonely bear, right? For a long time, I've been a lonely bull. Okay, you got to remember that. We were on this channel for a long time, all throughout here, talking about this being the most angriest, most hated, most doubted, most shorted rally in history. I was a very lonely bull during this phase, okay? And pretty soon I expect to be a very lonely bear. Now, if I'm not a lonely bear and everyone's bearish, then that would give rise to the idea that we're going to be buying a dip later in life, okay? But just watch that sentiment, okay? If people are angry at me for selling, and if people are upset with me and annoyed or laughing at me for selling my Bitcoin into the end of this year, then that to me will just be another sign that once again, at the inflection points when it pays the most to be a contrarian, I have made the right decision. So I'm your boy Camel. If you're a level 3 member, look out for the members only video I'm about to post for you guys. For everyone else, consider subscribing, especially if you made it this long. And until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a